Hey guys, it is Julie here with TipRanks. In today's video, I want to go over a few stocks that are Dividend Kings. Now, not only do these companies have an incredibly reliable dividend paying history, but they also come in with strong buy ratings from analysts with some pretty attractive upside. So dividends plus growth, you can't get any better than that. Just before we get into these three companies, I just want to let you guys know that this Friday at 12:30 Eastern Standard Time, Richard Allen and I will be going live for our Friday market recap. So make sure you mark it in your schedules and join us on the call so you can get in there on the discussion of all the happenings of this week. And of course, if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now, just before we get into these three stocks, I want to go over quickly what a dividend king is. So these are companies that have not only been paying a dividend for over 50 years, but they've also increased that dividend each of those years. This is a great thing to look for when building a solid dividend portfolio, as that past history of paying dividends is a pretty good indication that they intend to continue paying that dividend in the future. The first company on our list today is probably one that you've heard of before. They've been around for well over 100 years and paying a dividend for 58 years. That is Johnson & Johnson. Their stock trades under the ticker JNJ, currently priced at $164 per share. They pay a quarterly dividend of $1.06 per share for a yield of 2.46. Their last ex-dividend date was on May 23rd, so we'll have the next one coming up here in a couple of months. And on the TipRanks Smart Score, they do come in as a 9 out of 10 for an outperform rating. We have seen a bit of a drop in TipRanks investor sentiment, but very bullish news and blogger opinions. Now, Johnson & Johnson probably doesn't need much of an introduction as they're a very well-known brand. Notably, they were one of the companies that came out with a COVID vaccine this past year. They deal with consumer health, medical devices, and pharmaceutical products. In fact, the list of brands that are underneath this company is way too big to go through, but you'll see a ton of name brands on there that you'll recognize from everyday use. This includes some #1 recommended brands like Listerine, Band-Aid, Tylenol, Neutrogena, and Aveeno. Since their founding 135 years ago in 1886, the company has grown to become one of the world's largest and most broadly based healthcare companies, with approximately 132,000 employees across the globe working every day to help change the trajectory of health for humanity. In their latest first quarter results, they saw their worldwide sales increase 7.9% to $22.3 billion. Their diluted earnings per share came in at $2.32 for a 6.9% increase, and the adjusted diluted earnings per share increased by 12.6%. One analyst from Morgan Stanley recently initiated coverage on the Johnson & Johnson stock. He anticipates strong performance from all three of Johnson & Johnson's business segments, including pharmaceutical, medical devices and diagnostics, and consumer. Pharma's momentum should remain strong. MD&D should see growth accelerate against easy COVID comps given a better cadence of new product introductions, and the consumer segment has durable growth prospects. The Johnson & Johnson stock has 7 current analyst ratings altogether, and as I already gave away at the beginning of the video, it is a strong buy. That is based on unanimous buy ratings and an average price target of $192.80, which would be an upside potential of over 17% for this next year. The most recent came just 2 days ago with an upside of nearly 22%. Now, this second company is not as recognizable as Johnson & Johnson. You won't see their products on the shelves of a drugstore, but they have been around for a long time and paying a dividend for 65 years. That is Parker Hannifin. They trade under the ticker PH and are currently priced at about $307 per share. And I just want to take a second, as I know the stocks we're mentioning today definitely have some higher price points, but just to remind you that fractional shares are always a solid option. You'll still get all the same growth and dividend exposure, and you don't have to be buying entire shares all at once. Parker Hannifin pays a quarterly dividend of $1.03 per share for a yield of 1.36%. And again, we did just miss their last ex-dividend date on May 5th, so the next one will be coming up here in a couple of months. On the TipRanks Smart Score, they do come in with an 8 for an outperform rating. We have very positive TipRanks investor sentiment, along with positive technicals and bullish blogger opinions. Parker Hannifin is the world's leading diversified manufacturer of motion and control technologies and systems. The company's engineering expertise spans the core motion and control technologies, from electromechanical, hydraulic and pneumatic, fluid and gas handling, filtration, sealing and shielding, climate control, process control, and aerospace. Parker Hannifin employs approximately 50,000 people across 49 different countries. They've been around for over 100 years, and with annual sales of $13.7 billion in fiscal 2020, they're a Fortune 250 global leader in motion and control technologies. And that dividend that I mentioned they've been paying for 65 years puts them among the top 5 longest-running dividend increase records in the S&P 500 index. In their recent Q3 earnings report, they saw 5 all-time quarterly records for net income, earnings per share, and segment margins for Parker, Industrial North America, and International. Their Q3 year-to-date cash flow from their operations was also a record at $1.9 billion. One analyst from Jefferies recently reiterated their buy rating. That analyst stated that with global stimulus and significant pent-up demand, Parker Hannifin sees the potential for an elongated industrial cycle. In the early 2000s, they observed a 5-year period of nearly 15% annual growth. For those who like to think big, baking in a similar level of double-digit growth at 30% incremental through 2024 would result in earnings per share north of $27 by our math, nearly double fiscal year 2021 levels. Now, the Parker Hannifin stock has 12 current analyst ratings, coming in as a strong buy based on 11 buys and 1 hold. The average price target of $357 would be over 16% growth potential. Our third Dividend King today is another recognizable name and quite possibly a store you visited during the pandemic with all that time on your hands for home improvement. That is Lowe's. They trade under the ticker LOW, currently priced at $194 per share. They also pay their dividend quarterly at 80 cents per share for a yield of 1.65%. Lowe's next ex-dividend date is coming up on July 19th, so still time to get in before their payment date of August 3rd. And once again, we have an outperform rating with a 9 out of 10 on the TipRanks Smart Score. We have very positive TipRanks investor sentiment, bullish blogger opinions, positive technicals, and fundamentals. Lowe's is a Fortune 50 company and the world's second largest home improvement center. They operate or service more than 2,200 home improvement and hardware stores and employ approximately 220,000 full-time and 120,000 part-time people. They opened their first store 100 years ago in 1921 and have been publicly traded since 1961. They've been paying their dividend out for 59 years. Lowe's shared their Q1 earnings report back in May. They reported net earnings of $2.3 billion and diluted earnings per share of $3.21. Excluding some changes, that first quarter diluted earnings per share increased 81% from $1.77 in the first quarter of 2020. Their total sales for the first quarter were $24.4 billion compared to $19.7 billion last year. Comparable sales for the U.S. home improvement business increased 24%. One analyst from Credit Suisse recently raised their price target on the Lowe's stock. The analyst was encouraged by the progress made on the various cost optimization, store productivity initiatives supporting upside to margin outlook for this year and into 2022. The housing pro backdrop remains strong, and Lowe's indicated May second quarter to date tracking is in line with the April 2-year compound annual growth rate of 37%, which the analyst sees as encouraging considering the elevated comps between mid-April through mid-May last year. The Lowe's stock has 21 current analyst ratings and comes in as a strong buy based on 17 buy ratings and 4 holds. The average price target of $230 would mean a 19% upside potential over this next year. So there are 3 Dividend King stocks paying really healthy dividends and with some upside potential. Like I said, can you get any better than dividends plus growth? Let me know your thoughts in the comments down below on these 3 stocks and what other fantastic dividend stocks you have your eye on. I know there's a lot out there. I had to narrow it down to 3 today, but that does not mean any of the others aren't also fantastic. Love hearing from you guys, so let me know your favorites down below. Keep in mind, these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Please make sure you're always doing your own research and due diligence before making any investment decision. If you made it all the way to the end here, make sure you hit that thumbs up button and put it on your calendars for Friday afternoon to join Richard and I on our live stream Friday market recap. Thank you guys so much for watching. We'll see you back here next time.